Hello, this is David Disraeli, President of the Personal CFO Incorporated here in Austin, Texas. Today we're going to talk about the Texas Series LLC. This is a highly underutilized tool that's available for investors and business owners. What are the key benefits? One of the key benefits of a Texas Series LLC is that you only have to file one time. Even though you may have multiple entities underneath your master entity, you only file with the state one time. You have the ability to file and create multiple and separate entities under the master entity in a very simple fashion. You only need one tax ID number. You can get multiple if you choose, but you only need one to operate a Series LLC. There is no federal filing requirements for a single member LLC, which would be an individual or a married couple. Otherwise, you simply file what's called an informational return. You do not have to file a tax return under any circumstances because it's considered a pass-through entity or disregarded entity for tax purposes. Each series is considered by law to be a separate entity. Now, that means the creditors of one series may not attach the assets of another series. Each series may have different ownership and sharing arrangements. So one could own a business by one person while another may own a rental property with three partners. Most importantly, property in an LLC does not go through probate. This is very important for people that own real estate. Probate in Texas is not that big a deal, but it is time consuming and it does cost money. Once anything is inside an LLC, whether it's a company or property, the other managers can continue operating it without having to go through the probate process. Let's use an example. We're going to create what's called a master LLC. This is the basic LLC using the Series LLC formation in Texas, where the members are a husband and wife. Once it's filed, then they can go on and create multiple series underneath it. We're going to call them Series A, B, and C. They may be separate properties, or they may be separate businesses, or some combination. There's a Chinese wall that separates each series from the other. So if Series A gets attacked, Series B and Series C are exempt from attachment, meaning the creditor of Series A cannot get to the assets that are in Series B and Series C. Series C may just have a large brokerage account or checking account with cash in it. The creditors of Series A do not have access to those assets by law. So what are the mechanics of forming one of these things? You have to file a special formation document with the Secretary of State of Texas. You can't go on their website and click Series LLC under your filing options. It's not there. You have to file an LLC and then tell them it's a Series LLC using a special form. Once they send back a certificate of formation showing that it does exist, you can then go on the IRS website and get an employer identification number or tax ID number for the master LLC. Then you have to create an operating agreement for a Series LLC, which is different than a regular LLC. Once you do that, you can create addendums each time the series is formed, which is a one-page document. You form a series by going on the state's website and creating a DBA or assumed name certificate. It takes about 10 to 15 minutes and costs $25. And that's it. The next subject is probably going to be the most important. Forming an LLC is one thing. Anybody can do that. Surviving attack is different. These are two different issues. First, the master entity in each series must have separate accounting. That doesn't mean bank account. It just means separate accounts under QuickBooks or any other accounting program or even an Excel spreadsheet. As long as they're separate, you're good. Never commingle funds between different series. That is a no-no. I recommend that you hold annual meetings, even if it's with yourself, and keep minutes, which are just notes from each meeting. This is another way to show a would-be creditor that your company is a real company that was not formed for purposes of avoiding creditors.